Hi, my name is Sam Powell and I'm the lead analyst here to give you a market update for the month of September for those looking into the property market in Australia. At the moment, home values have increased 2.5% over the last 3 months, a good growth rate for the national average in Australia. So what we're actually seeing is there are segmented markets happening in Australia, but overall we're seeing positive price growth coming through, which is a good sign. It's also indicating, obviously, the confidence is coming back into the market after the 13 rate rises that we have seen. So entering into the spring selling season, as they call, we're seeing more listings coming on the market, and agents are also indicating more appraisals going through. Now, this is somewhat of a sign. With more supply could be an indication of lower price growth, but we're coming off a really low base, so demand levels are really quite strong and there's not enough supply in the market, so it's being eaten up quite fast. Now, what we're also keen to express is it's the key assets that continue to grow in value and dominate that market. So this is why we talk a lot about finding the A-grade property assets in the market, because it's really going to help your growth potential moving forward. Jumping into auction clearance rates, now they're a really key metric to track, as it gives us that level of confidence in the market. Now, it's never just one metric to track, it's always a conglomerate of a number of them that help you analyse the Australian property market. Auction clearance rates are really skewed towards Sydney and Melbourne because they're heavily auction markets, but it is a really good indicator to track. And for the last 4 weeks leading up to the start of September, we saw a slight uptick in the auction clearance rates, going up to 66.1%. From the previous month is 65.6%, and this is off the CoreLogic data that we come and we analyse each month. So what that's indicating to us is that there is good confidence coming into the market. People are more willing to go to auction. Properties are being purchased at auction. So with those increased confidence levels, it tends to be a leading indicator into future price growth as well. Sales volumes and vendor discounts. Now, take note, because these are two really key metrics to track. So when you're looking at the supply and demand metrics, obviously the more sales volume that goes up is an indicator of more supply coming to the market. The vendor discount, on the other hand, is a sign that if vendors are increasing their discount rates for what they're willing to sell their properties for from the asking prices, that's a weakening market. What we're seeing in the month of September is that the vendor discounts is actually reducing. So we're at negative 3.8% at this point in time, and that's been contracting over the last few months. So that's showing a sign of more confidence coming back into the market once again, in that vendors aren't willing to sell their properties for a discount anymore. Looking at the sales volumes, we've just been tracking on a nationwide basis of just over 38,000 sales for the month leading to the start of September. And this is looking at from the 5-year average, which sits around at just under 40,000 sales per month, is our indication that we're getting closer towards a more balanced market, and we're in the parameters of a balanced market overall at the moment. Now, you'd hear a lot of things around days on market and what that means for the suburb that you're buying into. Now, for us personally, from an investment standpoint, you don't really want to be investing in markets that are over 60 days on the market, because what that is indicating is that there's not a lot of demand of people actually trying to buy those assets. If we can track markets that are actually in that pivotal point where the days on market aren't so tight that there's just everyone throwing money at it, we don't want to be entering into those because that's too heated. But you also don't want to be entering into those markets where no one's really motivated to jump in and buy a property that's come on the market that week. So the days on market have increased slightly, but they're coming off from a really low base. So we saw the low in houses coming through around that September period last year of 20 days for houses and 25 days for units. Last month we were seeing that they were at 30 days, and now they've increased to 32 for the month starting September. So not a lot of movement over the last month from the days on market for houses or units, to be fair, but they're in that really healthy range from a nationwide level. 32 days is that perfect point where you still see those good price growth indications coming through, and that's what we want to see for a healthy, balanced market to give us confidence. And you can also see that coming through in the property market and the the rhetoric that's coming out in the media, where we've shifted now from this fear mindset into more of a balanced, optimistic mindset. Turning our minds to the rental market now, and we've seen rental price growth go up quite dramatically, and we've seen that quite prominent in the media, where people are being priced out of certain markets. Now, when you're seeing this price growth come through with rental asking prices, as they increase, the mindset of the renter can shift into the mindset of a potential buyer, and that's going to add more demand into a market for housing, which then leads to capital growth. So we're seeing that shift coming through in certain markets in Australia, where property renters are becoming buyers and adding that more demand into that market, which is where we want to be focusing in on, because if you get it right, you can get that shift and getting that short-term growth into your portfolio, and you're not just sitting around waiting for that long-term appreciation of buy and hold forever. So looking at the rental price increase, we've seen a 9% rental increase on a nationwide basis over the last 12 months. Now that is really strong, and that's a serious indication of what I was been talking about around the lack of supply in the Australian property market. It's putting a lot of pressure on the rental market because there's not enough houses to house these people that are coming into our nation. Dwelling approvals are a forward-looking indicator. So obviously the more dwellings that are approved into the market, then it increases the chance of more dwellings being built, and that helps with the housing supply issue that we're seeing. So what we've seen over the past month is that dwelling approvals have ticked over just over 13,500. That's still 23% below the decade's monthly average. So as you can see, we're still below where we need to be in order to house these people. Once again, for us, we're looking at that as a prosperous time for capital price growth for investors and people who own property. But once again, it's a downward factor to softening the rental pressures that we're seeing in the market at the moment. Looking into the capital and the regional markets, we always like to compare which is performing better from a investment perspective, and a lot of questions do come around from investors asking, well, which is best to invest in? Is it to the capital cities, or is it to these regions that we're seeing not only good price growth but also good cash flow? And the answer to that question is it always depends on you as the individual and your personal circumstances. But for the month of September, well, we've seen a 1% increase in the combined capital cities coming through based on the CoreLogic data that's been released, and the regions have seen only a 0.8% increase over the last month. So both really strong price growth coming through. If you look at that from an annualized basis, for the combined capitals, there's potential there for a 12% increase on price, which is a really strong performance when the average sits around that 6 to 7% nationwide. The other key metric is also looking at the 28-day rolling average of the price growth. So if you're looking at this chart, you can see that we've bottomed out around October 2022, and we saw negative property values all the way through up until about March 2023, and then we start to see positive price growth coming through from the combined capitals at that point in time. Now, we've been talking about this for a while now. It's not new to us, but that's why we've been so prominent in telling people to get their ducks in a row, because we're going to see some really good price growth coming through, and we have in certain pockets in Australia, both in the combined capital city regions and also the regionals. But the key thing here is to make sure that it all fits within your personal goals and budget timeframe. Another key metric that we look into is the cash rate. Now, there's a lot of information out there around the increasing in interest rates is making it less affordable for property purchasers to go through. What it really is indicating to us is, with this slowdown in the cash rate, we've been anticipating this to happen for a few months now, and we're also seeing the confidence come back into that market. So when I'm looking at the cash rate metric, we've seen a few months now of pause, and we saw the confidence coming back in April this year. And now with these pauses and the change in the Reserve Bank governor, I feel like there's a fundamental shift in people's psychology, as the property market isn't crashing, it's not falling, it's back to a more neutral standpoint. And as a result, people are more willing to either sell their property because they feel they're going to get an increased sale price, and also gives buyers more confidence to buy property, because no one wants to buy something that automatically goes down in value, right? whole entire Australia landscape is looking segmented. So the key here is to understand where the markets are that are actually growing in value and those that have too much of a supply risk involved in them. So we always lean onto it, say there's markets within markets, and it's really important at this point in time to be laser focused on what it is that you're actually looking for, and then drilling further down into the data, because it's that opportunity cost of getting it wrong which is fundamental to the success of your actual property journey and your price growth over time. So if you do have any questions, please reach out, and happy property hunting.